computer. Okay, so we're starting the recording, just so you all know. And today we talk about long-term assets. So we're going to, this is chapter 7. We know kind of the scenario, but we're going to spend this week dealing with long-term assets, and then we'll go through the homework. Okay, any questions at all before we start? Can you hear me loud enough? Am I coming across okay?
Yeah, we can hear you.
Yeah.
Okay, guys, there are long-term assets that are physical in presence, which we call tangible assets. And there are long-term assets that you cannot see that we call intangible assets. Tangible assets include those things you can clearly touch and feel: land, improvements of land, buildings, equipment, even natural resources. You can see them. They have a physical substance. Intangible assets lack physical substance, and often their creation is a result of contracts between companies. These consist of patents, trademarks, copyrights, franchises, and goodwill. As you see in this slide, Darden Restaurants, which has a lot of different places: Olive Garden, Red Lobster, Capitol Grill, Longhorn Steakhouse. Those are the ones I know of. They've got a couple others, but I'm not familiar with them. You see their assets, their long-term assets sitting on the balance sheet, and you see the property, plant, and equipment is significant, but even their intangible assets are pretty significant on this slide. So, how are long-term assets acquired? Usually, they are acquired through purchasing them. So usually the way we record a long-term asset is based on not only the original cost of the asset, but the expenditures necessary to get that asset ready for its use. So land. Land includes the cost of the land and all the necessary costs to get the land ready for its use. Things such as real estate commissions and fees. If you're required to pay some back property taxes in order to purchase the land, those would also be added to the cost of the land. In order to utilize this land, if you have to fill it or level it or clear it or excavate it, all of those costs would also be added to the price of the land. So here's an example. You purchase land and then you add to it commissions. If you paid those commissions, back property taxes, title insurance, possibly cost of removing an existing building. And then you would subtract out the monies you received from removing that existing building. Then we've got costs of leveling the land. Okay, the total cost, as you see, that we would show in the records would be $590,000. It's not just the $500,000 for purchasing the land. It's all of the other costs also to make up the price of the land. Here's our first problem here. Italian Pizza Company purchased land as a factory site for $90,000 prior to construction of the new building. The land had to be cleared of trees and brush. Construction costs incurred during the first year are listed below. So you see we have here the land clearing cost, the sale of firewood to a worker, architect fees for a new building, title investigation of the land, property taxes on the land for the first year, and building construction costs. Determine the amount that the company should record in the land account and in the new building account. So I'm going to give you a minute to attempt this, and let's just see what you come up with. Give you about 60 seconds here, okay? Okay, so let's look at this. We're going to have for the land, come on there. For the land, we will take the purchase price of the land clearing costs, minus the sale of firewood to a worker, plus the legal fees for the title investigation of the land. So the portion that makes up the cost of the land will be $98,100. For the building, we'll use the architect fees and the building construction costs. Know that the property taxes on the land of the $3,000 will be recorded as property tax expense over the first year. So ideas of land improvements would include parking lots, sidewalks, driveways, landscaping, lighting systems, fences, and sprinklers. Administrative offices, retail stores, manufacturing facilities, and storage warehouses are examples of buildings. The cost of getting the building ready for use may include real estate commissions, inspection costs, and remodeling costs. But those costs that occur every year get expensed. Utilities, insurance fees, maybe association fees, those are expensed each year. Now, in regards to equipment, machinery used in manufacturing and computers or other office equipment, vehicles, furniture, and fixtures would be classified under the category equipment. Ideas of added expenses would be sales tax, shipping, assembly, and any costs that get the equipment ready to be used. Costs that are incurred, such as maintenance expenses, are expensed each year. Think of like oil in your car. Oil just keeps the car running. And so windshield wiper fluid, that's just a maintenance expense. So in this case, if you're looking at the cost of equipment, here you would see the purchase price of the equipment, the sales tax of the equipment, any transportation we pay, and shipping insurance, along with paying for people to install that equipment, would be the cost we would show for equipment. Oftentimes, individuals purchase a group of assets at once. A basket purchase is what we call them. What we do in determining how we allocate those costs is we take the purchase price and we base it on the relative fair values of the various individual assets. So in this case, if we're purchasing land, building, and equipment for $900,000, we determine, okay, what is the percent of land to the total? What's the percent of building to the total? What's the percent of equipment to the total? So we'll come up with a ratio, a percentage, and then we'll allocate the purchase price based on that percentage. So as you see here, the land of $200,000 will allocate 20% of that land to the total, because 200,000 divided a million is 20%. So allocate 20% of the purchase price of 900,000 to the land. We'll allocate 70%, or 700,000 divided a million, of the purchase price to the building. And we'll allocate 10% of the equipment to the building. You see, each of those items on their own would total to $1 million, but we're purchasing the whole basket for 900,000. So we allocate that accordingly. So here we've got Red Rock Bakery purchases land, building, and equipment for a single purchase price of $600,000. The estimated fair values of the land, the building, and equipment are $175,000, $455,000, and $70,000 respectively, for a total, sorry guys, estimated fair value of $700,000. Determine the amounts Red Rock should record in the separate accounts for the land, the building, and the equipment. So do you see here for the land, if the cost is 100, or the value at fair value is 175 out of 700,000, because you add them together, you come up with a percent here. 25% of the purchase price will be allocated to the land. We do the same with the building. If the building's estimated value is 455,000 out of the 700,000 total, that equates to 65%. So 65% of this purchase price will be allocated to the building. And the same goes for equipment. Equipment would show 10% of the equipment to the total. So guys, you're going to do this one and post it to the chat. A company makes a basket purchase of land, buildings, and equipment with estimated fair values of $70,000, $150,000, and $30,000 respectively. The purchase price is $210,000. How much should be recorded to the land account? I'm going to give yourselves a couple minutes and then see what you think. Okay. I see one of you's posted. And the others, guys. Anybody else? Olivia has it in. Has anyone else put it in yet? Can you hear me?
Yes.
Yes.
Okay. So I'm asking you guys to work this through and put it in, and now I have 2 responses. So 58,800 is the correct price to record to the land account. So you would take the fair values of those 3 assets and the 70, the 150 plus the 30, and you would get 250. The land's value is the 70 divided by 250, or 28%. So you would take the purchase price times 28% to get the land's purchase recorded value or cost for the books. Does anyone have questions on this before we move on?
So to get the total fair value, you just add the 3, like the land, equipment, and the buildings?
Together to come up with a percentage. And then whenever you come up with that percent to the total, you take that percent times the purchase price to come up with the allocation between the various building, equipment, and land.
Okay, got it.
Okay. So now, what are natural resources? Oil, natural gas, timber, salt. They get distinguished from other assets because they can be physically used up, which we call depleted. Natural resources get recorded at cost, plus all the costs necessary to get the natural resource ready for its intended use. So what we're learning here is there's a variety of assets that we may record based on what kind of company we're dealing with. Tangible assets, such as land improvements, buildings, equipment, and natural resources, are recorded at cost plus all costs necessary to get the asset ready for its intended use. Now we're going to talk about intangible assets. They lack a physical substance, yet can be extremely valuable. They are either acquired by purchasing them or developing them internally. So a patent is an intangible, which basically gives an exclusive right to manufacture a product or to use a process. When I think of patents, I also think of drugs. Drug patents are significant. And the person who has that patent has the exclusive right to manufacture that product for 20 years. When those patents are purchased, we capitalize it, which means it's an asset. When patents are developed internally, the only thing we capitalize are the legal and filing fees. All other costs get expensed in the year they are incurred. Copyright is the exclusive right of protection given to the creator of a published work. It's granted for the life of the creator plus an additional 70 years. This allows the holder to pursue any legal action against anyone who tries to infringe on the copyright. And we'll do the accounting the exact same as we do patents. A trademark can be words, slogans, or symbols that distinctively identify a company, product, or a service. You know, the apple with the bite out of it. How many, we all know that's Apple. The target, I think, is kind of cool. We all, without even any words, the red circle with the white in it also, we all know is from Target. These trademarks can be renewed indefinitely over 10-year periods. With the trademark, we capitalize the legal costs, the registration, and design fees. Any advertising costs get expensed as they're incurred. Now, franchises are when you have an exclusive right to use the franchisor's name and to sell its products within a specified geographical area. You're seeing some of these that are real common. Jiffy Lube or Ace or Midas or Subway, McDonald's, Great Clips. Basically, the franchisee will record the initial fee as an asset, as an intangible asset. But then any additional payments that are paid to the franchisor throughout the life are usually expensed as they're incurred. They're usually annual costs to pay them a portion of the sales. Goodwill is very interesting. Goodwill gets recorded only when one company acquires another company. And the way goodwill is determined, you take the purchase price minus the fair value of all the identifiable assets. And the difference, anything over that amount, we will show as goodwill. Net assets are assets acquired minus the liabilities that the purchaser automatically assumes related to those assets. Goodwill is the amount of that purchase price that goes above and beyond those identifiable net assets. So when one company purchases another company for $36 million, and they see that there are identifiable assets of $50 million, identifiable liabilities associated with those assets of 24, it means the fair value of the identifiable net assets really is 26. The 50 minus the 24 gives us 26 in net identifiable assets. The difference with the purchase price minus the net identifiable assets of 26 shows that difference will be categorized on the books as goodwill, that amount above and beyond the net identifiable assets. Any questions so far, guys? Does that make sense? Remember, intangible assets include patents, copyrights, trademarks, franchises, and goodwill. Okay, so here we have a problem. Okay, here we've got Satellite Systems has modified its Model Z2 satellite to incorporate a new communication device. The company made the following expenditures. We've got basic research to develop the technology, the engineering design work, the development of a prototype, testing, legal fees, the patent application, legal fees for successful defense of the new patent, and a total. Now it says that during your year-end review of the accounts, you discover that the company has capitalized all of the above as cost of the patent. Management says that the device represents an improvement of the existing communication system of the satellite and therefore should be capitalized. But guys, which of these above costs should be capitalized to the patent account? And which of these should be shown as research and development expense in the income statement? What are the criteria? I'm going to give you 2 minutes. Be right back. I want you to attempt this. Okay. So the items to be capitalized only include legal fees for a patent application and legal fees for only a successful defense. The expenses, research, engineering work, the prototype, and the testing are all expensed in the period that these costs are incurred. Really important to understand we're conservative in our approach. We don't want to overstate our assets. Now, what are the basic criteria for determining whether to capitalize or expense intangibles? When we purchase intangible assets, we're usually capitalizing them. Internally developed intangible assets are usually expensed, except for certain legal fees. So guys, I want everyone to attempt this. Which of the following is an exclusive right to manufacture a product or to use a process? What's that going to be? patent, isn't it? Now, what happens after the acquisition? Expenses after the acquisition, such as repairs and maintenance, additions, improvements, and litigation costs, we might expense or we may capitalize. Now, we expense them if they only benefit the current period, but we're going to capitalize them if they benefit future periods in addition to this current period. So items such as repairs and maintenance, they benefit the current period. That's why we're going to expense them. But if they do benefit future periods, we're going to capitalize them. If we have new components or replacing new components that are going to allow it to have an additional life or expand their capabilities, we're going to capitalize that. No, a legal defense of intangible assets, if it helps future periods, we're going to capitalize it. But of course, an expense if the defense is unsuccessful will be expense because there is no benefit in future periods. Remember, we capitalize, which means record as an asset, expenditures that benefit future periods, and we expense items that benefit only the current period. So guys, let's look at this one. I want you guys to attempt this one. Which of the following costs would be expensed? Which would be expensed? Not A, that will benefit future periods. Not B, not C, but D would be expensed. Now, cost allocation is just a nice way of talking about depreciation. Depreciation in dictionary terms is not depreciation in accounting terms. In a dictionary, it says depreciation is decreasing the value of an asset. But our purpose for depreciation is really more of an allocation of an asset's cost to be expensed over time. So when we purchase an asset, that asset's going to benefit this current period plus future periods. The time periods that this asset will be utilized, we're going to allocate a piece of this asset throughout those periods. This is what we call depreciation, the allocation of the cost of this asset over its useful life. So when a local Starbucks pays $1,200 for equipment, an espresso machine with a useful life of 4 years, to record this depreciation, we take that $1,200, divide it by 4 years, which gives us $300. We'll debit depreciation expense and we'll credit accumulated depreciation. So after the first year, on the balance sheet, we'll show our $1,200 machine, but will less this contra account, the $300 in accumulated depreciation, to show a true net asset book value of $900. Remember, depreciation is an allocation of an asset's cost to be expensed over time. Land can never be depreciated. Just know that. Other assets can be depreciated, but not land. So there are three primary methods to be utilized when we depreciate or allocate a company's cost over time. The most common is straight line. There's also one called declining balance, and then an activity-based. So what we do when we use various methods, it's just the manner in which we're going to take cost over its useful life, over its periods. When we use straight line depreciation, know that we depreciate it only to its estimated residual value. Once the asset has been used up, what's it worth at the end? In this example, a truck that we purchased for $40,000, at the very end of its life, we're estimating has a value of $5,000. So when we use straight line, we'll depreciate the difference, the $35,000, over its useful life. When we use the straight line method, we take the cost of the asset minus the residual value, divide it by its estimated useful life. So 35,000 divided by 5 years is 7,000 per year. So you see here, the first year, we take 7,000, and our book value decreases to 33,000. Second year, the third year, the fourth year, the fifth year, we take 7,000. And at the end of its useful life, we show the residual value. The book value, we won't depreciate it under its residual value. Any questions on this, guys? Is that making sense to you?
Yes.
Good. But there are times we don't always purchase assets at the beginning of the year. In this case, if we purchase an asset on March 1st and we use it for 5 years, you need to be careful to prorate this asset during the first year and the last year. So in year one, if we bought it on January 1st, the depreciation would be 7,000. But because we purchased it on March, we only had it for 10 months out of 12 months. So we would only show $5,833 that year. And in year 6, we take then those last 2 months of the depreciation. So just remember, in simplistic terms, we're showing depreciation for the full year, but usually depreciation doesn't occur that way. We have to allocate it accordingly when it was purchased or placed in service. So guys, how much depreciation should be recorded in the first year for a delivery truck purchased on April 1st with a cost of $30,000, an expected life of 5 years, and an estimated residual value of $5,000, assuming the straight line method is used? What do you guys think?
That makes sense? If we're depreciating it as of April 1st, it's only 9 months in the first year. Right? Now, with all this, it's an estimate. We're estimating various assets will be able to be utilized for a period of time. But reality, guys, is sometimes things change. In this example, assume that after 3 years, Little King Sandwiches estimates the remaining service life of the delivery truck is going to be 4 more years. So the total service life of this delivery truck is 7 years rather than what they thought would be 5 years. Little King also changes the estimated residual value to $3,000 from the original estimate of $5,000. So what do we do in depreciation in years 4 through 7? One thing is we don't go back and change what we've already done. We just change going forward. So at the end of year 3, the book value was $19,000. We changed for a new residual value of 3. So our new depreciable amount we're going to depreciate is $16,000. Divide that by 4 years. We're going to depreciate $4,000 per year. Remember, guys, we never go back. Keep it as is. But going forward, we adjust the depreciation. This next method, double declining balance depreciation, can confuse people. And I'm going to just give you some tidbits on how to keep this very simple. Don't think of it like the straight line method. We handle it differently. If this truck is for $40,000 and we estimate a 5-year life, that means we're going to take 20% a year under straight line. The whole asset is at 100%. Over 5 years, we take 20% of that asset each year to allocate the cost. What we do when we do double declining is we take that rate of 20% and we double it. So all we're going to do is take the book value, double the rate, which in this case is 40%, and we're going to take 40% of this asset without any residual value, 40% the very first year. Then we come up with a new book value on the asset. The next year, we take 40% of that new adjusted book value. It's now gone down to $24,000. So in year 2, we take $24,000 times 20%, which is $9,600. Do you see we're accelerating the depreciation in the earlier years? Then at the end of the second year, we have an adjusted book value of $14,400 times 40%. The key here, guys, is we take into account the residual value at the end, meaning we cannot depreciate it below that residual value. So do you see in year 5, we only took depreciation of $184 because that's all we could take
to get to the book value of 5,000. You can't depreciate below the residual value. But the important piece to be aware of here is when we do the depreciation for double declining, we use the $40,000. We don't subtract the residual value from the book value. We use the $40,000 and we double that rate, and we keep using that rate until we hit the residual value and we stop. When using the declining balance method, mistakes are commonly made in the first and last year of the calculation. In the first year, students sometimes calculate the depreciation incorrectly because they take the cost minus the residual value times the depreciation rate, but don't do that. Just multiply it by the cost of the asset times the depreciation rate. Then in the final year, some students incorrectly calculate depreciation expense in the same manner as in earlier years, multiplying the book value by the depreciation rate. But remember, under the declining balance method, depreciation expense in the final year is the amount necessary to reduce the book value down to the residual value. So how about this? How much depreciation should be recorded for the first year of a delivery truck with the cost of $30,000, an expected life of 6 years, and an estimated residual value of $6,000? Assume the double declining method is used. Okay. What do you guys think? Anyone else? So how do we do this? If the going straight line rate is 1 divided by 6, we double it. So instead of 1/6, we take 2/6 each year, or 33.33%. So 30,000 times 33.33%, the first year would be 10,000 in depreciation. Activity-based depreciation is very similar to straight line. You're basically estimating the allocation of depreciation over a certain factor. In this case, it's going to be mileage. So if it's
100,000 miles, we calculate the amount we depreciate per mile. So 35,000 divided by 100,000 expected miles is 35 cents per mile. So in the year one, when it was driven 30,000 miles at 35 cents, we take depreciation of 10,500. In year two, 22,000 miles at 35 cents a mile, we take depreciation of 7,700. And we continue to do that until we hit our residual value. Remember, with activity-based, we make sure when we calculate the per mile allocation, we do cost minus the residual value, which is our depreciable cost, divide that by the number of miles. Ultimately, the depreciation is going to play out to be the same. It's all about timing. With straight line, it's even over the years. With double declining, it's very great at the beginning, and then it decreases over time. And activity-based is based on the number of hours. Okay? So you see here, ultimately, we get the same depreciation. It's just different year by year. Most people in the United States use the straight line method. You see, very few people use those other methods. For tax purposes, we don't use these methods. We use an accelerated method called Makers for tax purposes. Most companies use straight line depreciation for financial reporting, but for tax reporting, we use what's called a modified accelerated cost recovery system. But for purposes of this chapter, you're going to learn about how to compute the straight line, the double declining, and the activity-based methods. So let's look here. The donut shop acquired equipment for $19,000, and the company uses straight line depreciation and estimates a residual value of $3,000 and a 4-year service life. At the end of the second year, the company estimates that the equipment will be used for 4 additional years for a total service life of 6 years rather than the original 4. At the same time, the company also changed the estimated residual value to $1,200 from the original estimate of $3,000. How much should the donut shop record each year the depreciation in years 3 to 6? I'm going to give you a couple minutes, and I want you to attempt this, guys, okay? I'm just going to stop the recording a minute, and I'll pause. Oops. As you see here, the first and second year of depreciation is $4,000 each. Then we come up with the book value after the end of year 2. Our $11,000 minus our new residual value of $1,200 gives us a cost of $9,800. Divide that by 4 years to get $2,450 each year. Does that make sense? Intangible assets. We don't call this depreciation. For intangible assets, we call this amortization. Amortizing intangibles. What we do for franchise agreements is we amortize the cost over 20 years. So instead of using a depreciation, we use amortization expense and we credit the actual intangible asset by the difference. Here, we've got a patent for a meat slicing process for $72,000. The original legal life of the patent was 20 years, and there are 12 years remaining. But due to technological obsolescence, the company estimates that the useful life of the patent is only 8 more years. Little King uses straight line amortization for all intangible assets. Record amortization for the first year. So what we would do is our 72,000 divided by 8 years gives us 9,000 per year. We debit our amortization expense and we credit our patent. Now, those intangibles that we use amortization for will be patents, copyrights, only trademarks with a finite life, and franchises. Intangible assets that will never be amortized. It's Goodwill and trademarks that have an indefinite life. Remember, amortization is a process similar to depreciation, where we allocate the cost of intangible assets over their estimated service lives. Intangible assets with an indefinite useful life will never be amortized. Which of the following intangible assets would not be subject to amortization? Boom, B. Okay. The next thing we're going to look at is disposing of assets. This generally happens in one of 3 ways: through selling it, through retiring it, or exchanging the asset. These are the 3 methods. So when we sell it, we dispose of it by selling it to another buyer. Most common method. When we retire an asset, it's because it can't be sold. It's no longer helpful for anybody. And an exchange happens when 2 companies trade various assets. So let's take an example and see how this plays out. The original cost of this truck is $40,000. The estimated residual value is 5. And we estimate the service life to be 5 years with straight line depreciation. What would happen if we sold this truck after 3 years for $22,000? So we had 3 years of depreciation, $7,000 a year. 3 years would be $21,000 of depreciation, right? And we are going to sell it after 3 years for $22,000. Well, think of this. We bought the truck for $40,000. $21,000 of depreciation means that our adjusted book value at the end of those 3 years is $19,000. 40 minus 21 is $19,000. If we sell it for $22,000, we show a gain of $3,000. So we would show cash coming in of $22,000. We want to get the asset off of our books, so we need to zero out the equipment of credit 40, debit our 21 to zero it out, and we show a gain of $3,000. Be careful not to combine the delivery truck cost and the accumulated depreciation contra account, and then credit the $19,000 difference to the equipment account. We have to move the entire delivery truck and remove the entire accumulated depreciation from the accounting records separately. Now, what happens after 3 years if we sell the truck for $17,000? Well, we know our book value at the end of 3 years is 19. So here we'd have a loss of 2,000. We'd show a debit to cash of 17, a debit to accumulated depreciation of 21, a debit to loss of 2,000, and a credit to our equipment of 40. What if instead of selling it, we just retire it? Then we have a loss of 19,000. In this case, we don't have any cash we're going to show. We just reduce the accumulated depreciation from our books, reduce the equipment, and show the loss of 19,000. Okay? If an asset is sold at the end of its first year of use, which depreciation method would result in the highest amount of gain or the lowest amount of loss, assuming the asset is used fairly evenly over its life? Well, the highest amount of gain, you're going to reduce your book value greater by taking more depreciation up front, and therefore having a larger gain using the double declining. So let's now talk about exchanging assets, not selling them, but exchanging them. So here we traded in an old truck for a new truck. Okay, so our new truck is $45,000 and we paid $22,000 in cash. So we've got our trade-in allowance. We take our truck, the old truck, minus our accumulated depreciation to come up with our book value. If, based on this, we've got our truck less the $22,000 we paid in cash, shows our trade-in allowance was 23. Therefore, in this situation, we have a gain of 4,000. We want to get rid of our old truck. We want to get rid of the depreciation, accumulated depreciation on it, show the cash we paid, show the new equipment, and as a result, in this scenario, we have a gain of $4,000. The key here, guys, is to fill out, to create a worksheet to fill out and see, okay, if this is the exchange and this is the basis or the book value of the old truck, do I have a gain or do I have a loss? If we dispose of an asset for more than book value, we record a gain. If we dispose of an asset for less than book value, we have a loss. Here, Abbott Landscaping purchased a tractor at a cost of $42,000 and sold it 3 years later for $21,600. Abbott recorded depreciation using the straight line method, a 5-year service life, and a $3,000 residual value. Tractors are included in the equipment account. How do we show the sale? We want to get rid of the tractor, credit that account. We want to debit our accumulated depreciation account. We show the cash we sold it for. And the difference is going to be a gain. What if instead of it being sold for $21,600, we sold it for $13,600? See, now we have a loss of $5,000. Now, this next section has various
profitability or ratios that I'm going to let you look at on your own. Because at the end of the book, chapter 12 or chapter 12, we'll be going over these. 13, I think it is. Okay, now, I was just listening to either British Petroleum or Shell discuss withdrawing from Ukraine is going to impose an impairment situation. And this is what we're talking about here, impairment, and how we determine if we have an impairment. Impairment means the asset that we show on our books may not be worth what we're showing on our books. So the way we look to see if that could be the case is by step one. To test for impairment, we look at the future cash flows of an asset and see, are those future cash flows less than the book value we're showing on our books? If the future cash flows are less than the book value, we've got an impairment. If they're not less than book value, then we do nothing. If the asset is impaired, then we will record the loss. And the loss is going to be the book value of the asset in excess of the fair value of the asset. So what is the book value showing on our books versus really what's the fair value of this asset? To see if we have an impairment, we're going to take the future cash flows and see if they're less than book value. If that's yes, then we will write off an impairment, a loss, by looking at the difference between the book value being greater than the fair value of the asset. So let's look at this example. Estimated future cash flows generated for this long-term asset are falling below its book value. Trademark has estimated future cash flows of $20,000 and a book value of $50,000. Okay, we've got an impairment because the estimated future cash flows are less than the book value. If step one is true, then we go to step two. And we have to write off the loss where the book value is in excess of the fair value of the asset. In this case, the book value is at 50. The fair value, what it should be shown, is 12. So we've got a loss of $38,000, the difference between the book value and the fair value. Therefore, what we would do here is debit our loss of $38,000 and credit our trademarks of $38,000. So the new book value of trademarks in our books will now be $12,000. Remember, the first step is to check for impairment. If it's impaired, then we look at how much the book value is greater than the fair value of the asset. An impairment loss gets recorded when the book value exceeds the estimated future cash flows. It's the only time we're going to record an impairment loss. Any questions, guys, before I go through the homework for you?